We appreciate the opportunity to speak to the Patina Nation today. We want to first take this time to provide you with our contact information. Please feel free to reach out to myself, Kyle, or Jonas at any time. We also want to remind everyone of the Patina Nation Retirement Plan. This is a wonderful program that Patina offers to the nation. This is a great way to save both pre-tax and post-tax contributions.
The main benefits of the Patina 401k plan are more savings than a SEP IRA,
There is no increase in administrative tasks,
keeps your retirement plan in compliance with government regulations,
no fiduciary liability increase,
very competitive costs.
and the opportunity to get a personalized wealth plan. Feel free to reach out to myself or Jonas at any time or visit patinanation.com for more information.
At this time, I would like to turn the presentation over to Ryan Boswick from Transamerica.
All right, thank you very much for the kind introduction, Jonas. Good afternoon, everyone. My name is Ryan Bostwick, and I'm excited to be here today. We're going to get the opportunity to take a very deep dive into the subject of Social Security. It is one of the core retirement planning subjects that any person who's getting close to or planning for retirement needs to take into consideration. Not only is it a pre-retirement planning exercise, it is an exercise or a benefit that you're going to receive for the rest of your retirements. Today's presentation is about you. I'm looking forward to the Q&A at the end of the presentation, but let's go ahead and get started. As I get started in the content, I'm going to skip just a few of the beginning slides because they really just stress that Social Security, the program itself, is a benefit to retirees, and we have more retirees in this country than we've ever had before. A rhetorical question for the audience on the line today is, how many of you still have parents who are alive receiving Social Security benefits? Keep in mind that as the aging of America continues, as we all continue to live longer, it puts more and more people into the program. And the program has come a very long way, starting in 1935. This particular slide shows that monthly benefits did not start to be issued until the year of 1940. And take a look at that benefit amount for Ida Mae Fuller in 1940. What's interesting about Ida Mae is that she lived to be 100 years old at a time where virtually no one lived to be 100 years old. Maybe she would have served as a good warning sign of what was going to happen. Obviously, when a program of this size starts, it's not without consternation. And if you take a look at some of these interesting tidbits, specifically bullet point number 3, there were a lot of mistakes made. Keep in mind, before the Social Security Administration existed, before the Social Security program existed, people didn't really know what to do with these Social Security cards once they were issued. I love this as a fun fact. Over 40,000 people have tried to fraudulently use the Social Security number of a secretary of a wallet manufacturer at the very beginning. This slide, I think, is of particular relevance. We live in a country where the vast majority of us are able to spend the last years of our life outside the workforce. And when you take a look at this slide, it really helps us understand why. I'm going to refer to people in my own personal life during today's presentation. My mom and dad are baby boomers, like some of you on the webinar. And the reason why I bring that up is because my dad receives a large Social Security payment. My dad is a primary care doctor, and therefore he is qualified for a pretty sizable Social Security benefit. But as you take a look at the information on this slide, keep in mind, for my dad, Social Security replaces about 15% of his pre-retirement income. For the average American, Social Security replaces 40% of their pre-retirement income. And if you happen to be a lower wage earner, Social Security is replacing up to 75% of your pre-retirement income. Said simply, Social Security was built to be fair in the sense that the replacement ratio or the replacement percentage of your pre-retirement income was higher for those who ultimately made less. And that right there is the reason why the vast, vast majority of Americans ultimately find themselves retired. In today's presentation, we're going to go through this list of questions, but maybe more importantly, we're going to try our very best to personalize it to you. Our goal is to share with you numerous examples that will allow you at the end of this call to have a better idea of what it is you're going to do in the context of your own Social Security planning. Now, of course, there is one constant thing that people have been told about Social Security most of their lives. And of course, that one constant thing is the program going to be there for you? The vast majority of American workers aren't taking into consideration their Social Security benefits in the context of their financial plan. So let's talk about what the government tells us. The government this spring reinforced that there are current reserves there. Keep in mind, for the first 5 decades, 6 decades of the Social Security program, we were collecting more in taxes from workers than what we were paying out in retiree benefits. Of course, with the baby boomers aging, going into retirement, and now ultimately being halfway into retirement, the program has been paying out more than what it brings in tax revenues. And what this slide suggests is that the government believes the current reserves will run out sometime around the year 2034. A lot of people hear that, it catches headlines. And when it catches headlines, people become convinced that the program will be broke or bankrupt at that time. Keep in mind, the only way that this program could ever be broke or bankrupt is if the federal government stopped collecting payroll taxes from workers. And I don't know about you, but I think the chance of that is small to zero, right? And so what does that mean? It means as long as the government is collecting payroll taxes from workers, the FICA tax, there's always going to be some money to pay some of the benefits. The government believes that they'll be able to cover 77% of all benefits through the year 2092, even if there are no reforms or changes made to the program. A 55-year-old today won't likely to have to worry about his or her benefits being affected until after age 71 at the earliest, assuming no other changes come through quicker. I would like to talk a little bit about what some of those changes might be, because the slide itself indicates that we're going to continue to have a worker to retiree ratio problem. Keep in mind, the longer we live, the more time we spend in retirement. And those numbers are up to 70 million Americans right now of a total population of 320. 11,000 people every single day are turning age 65 and running into retirement. That will continue to put strain on the reserves. And we anticipate that there will be some changes made to the program itself. Some of those changes might include the possibility of increasing the payroll tax rate. As an employee, American workers pay 6.2% of their gross pay into the program. Some politicians are arguing that that be taken up to 6.5%. And that modest adjustment would go a long way into funding the budget shortfall. I personally believe that's very unlikely to happen, because keep in mind, it is politically detrimental to recommend raising taxes for all working Americans. And keep in mind, any person who's paid in the form of wages, tips, and earnings ultimately would see a tax increase if they raise the payroll tax rate. They're more likely going to focus on one group of earners in this country, and that particular group are those people who currently max out their payroll tax obligation. In 2019, just short of $128,000, you have met your payroll tax obligation, which means if you made $200,000 in 2019, you pay payroll taxes on the first 128. You no longer pay payroll taxes on the extra income above that amount. When it comes to Medicare, Medicare taxes are charged on all of your income. And so since the government takes that approach in terms of charging for Medicare insurance or future Medicare benefits, we anticipate they might go to a similar platform when it comes to the collection of Social Security benefits. I want to take a moment and make sure we all understand what taxes go in to Social Security benefits and the program itself. One of the most famous investors, I'm sure you all recognize his name, is Warren Buffett. Why do I bring up Warren Buffett? Well, he's worth a lot of money. And you might remember during the previous political season or election cycle, he quite oftenly was quoted saying he thinks it's unfair that he pays less tax than his secretary does. And I wanted to use that as an example for a very specific reason. You see, the highest paid workers don't get paid in the form of wages, tips, and earnings. That income subject to the payroll tax. They get paid in dividends or interest. And the reason why that's important to know is you don't pay the FICA tax on capital gains and dividends. Warren Buffett has chump change in comparison to the next person we're going to talk about, and that person is the owner of Amazon, Jeff Bezos. Jeff Bezos is the richest person on planet Earth. And Jeff Bezos' wages last year, the amount of money he earned that he paid payroll taxes on, was $1. Said simply, the wealthiest Americans largely aren't paying a lot into the program, and that is due to the way that they ultimately receive their compensation or pay. As we move forward, it's important to also consider that back in 1983, and I'm going to put you back in time right now, April 20th of 1983 to be specific, the question I have for you is, what were you doing that day? I believe that you weren't thinking about Social Security benefits, because life was probably a lot different for you in 1983. But on that day, your Social Security age, judged by your full retirement age, was raised. See, prior to 1983, all Americans had a full retirement age of 65. And during today's presentation, you'll realize that it's somewhere between 65 and 67, depending upon the year you were born. We do believe that the government will raise the full retirement age again for Social Security. They've done it once before. The blueprint is there. And as life expectancy continues to increase, we think it's important. Just consider that a few years back, there was a Time magazine article that had a beautiful baby on the cover. And you might remember this article, but it asked aloud, will that baby be the first person to live to 140? It's not so far-fetched. And obviously the modeling of this program was built in such that in 1935, when the program started, the full retirement age was 65 years old. And they were pretty scientific about it. They used life expectancy. And the reason why that's important is this program was never built to pay individuals benefits for 30 or 40 years. The modeling of the program was largely built to pay people up until life expectancy. And back in 1935, women still outlived men. They lived to about 66 years of age on average, and men lived to about 64. If we're going to apply that same model to the program today, the youngest Americans would have a full retirement age closer to 83 years old. Keep in mind that no American right now has a full retirement age beyond 67. And the last thing they're kind of talking about is changing cost of living adjustments. People who are retired understand these cost of living adjustments help their Social Security benefit keep up with the pace of inflation. I'm not sure that they're going to be able to change that much, because 3 of the last 7 years, the adjustment or the COLA adjustment made to your benefits was 0%. In a world of low interest rates and low inflation, these COLA adjustments aren't significant to begin with. We believe that some combination of what you see on your screen is going to be what are going to be the changes that are made to help the program's solvency looking down the road. At the end of the day, though, that shouldn't be alarming, because what it really means is the way that your program is, or the way that your benefit is determined and the program works is going to largely stay unchanged. So let's now talk about the way that Social Security works today for all of us on the webinar. A couple key terms. At your full retirement age, you will receive what they refer to as your primary insurance amount, or your PIA. Keep in mind, at your full retirement age, you receive your primary insurance amount. If you collect Social Security prior, you would receive a reduced PIA. If you delay past full retirement age, you would get an increased PIA. But every single one of us benefits is based around your full retirement age estimate or your primary insurance amount. For one to qualify for Social Security in the first place, you need 40 credits or 10 years worth of work. Keep in mind, credits only determine eligibility. You do not receive a higher benefit for simply working longer. The real goal is to pay as much payroll tax as you can in 35 years, and they use the 35 years in which you earn the most. So to make sure that we're crystal clear on this, if I only end up working 30 years, they're going to still use 35 years to calculate my benefit. And of course, for those 5 years, I don't show an earnings history. They're going to put in 0. And we want these averages to be high so zeros don't help. But my grandfather on my mom's side worked for 41 years. And when they calculated his benefit, they used 35. And which 35? The top 35, all adjusted for inflation. What else do you need to know in terms of how they calculate it? Keep in mind that working past starting your collection of your benefits may actually increase your benefit amount. Going back to my father, he was in school a long time, and my dad realized that when he turned on his Social Security payment, he received $2 less than the maximum. And he was curious as to why he wasn't receiving the maximum. We went back and realized the 35th year of income, he didn't fulfill the maximum payroll tax obligation. But keep in mind, my dad is still working, even though he's been collecting. And each year, the Social Security Administration searches for wages, tips, and earnings. And if your wages, tips, and earnings in a year are large enough to replace a smaller year, it will do that. And so you could still see pay raises by working past your initial collection age. If you are 60 or older and do not collect benefits or do not have an online Social Security account, you will receive a printed statement of benefits in the mail every year. We would strongly encourage anyone on this call, if they haven't already, to create an online account. It will help protect you against a fraudulent Social Security claim made under your Social Security number. The website to the Social Security Administration website is ssa.gov/my-account. You are going to be asked some personal questions. I'll give you a sample of a few that I was asked. In 1996, you opened a line of credit with one of these 3 banking or lending institutions. That one was pretty easy for me to remember because it turns out that was the first credit card I ever had. I remember I registered or enrolled in the card because they were handing out free t-shirts. I was a freshman in college, right? But they'll ask you something that's specific. They may ask you on another question, of these 3 vehicles, which one were you driving on a certain date at certain time? If you get their security questions right, you're in. You can print your statement on demand. I would remind you that your statement only updates once a year, but you can print it on demand. You can also use a few of their basic tools. Okay? For anyone who's under age 60, you will receive a printed copy that will be mailed to you every year in your life that ends in a 5 or a 0. Those statements get mailed to you, just like they always have, about 3 months prior to your birthday. Now, we've hit on this a few times, but let's put some numbers around it. If you had maxed out your payroll tax obligation for 35 years, the maximum benefit that you would receive in 2019 is $2,861 a month. That's almost $36,000 of Social Security income a year. Not chump change by any means. You can see that the average worker receives a little over $1,400 a month, and the average couple receives just short of $2,500 a month. Now, keep in mind, the average couple in America makes about $46,600 as workers. And as you can see, their Social Security benefit alone is replacing $30,000 or well over 50% of their benefit, going back to one of the first slides we looked at. Now, of course, if you can visualize your statement, or maybe some of you in preparation of today's webinar actually have a copy handy. It's 4 pages. When it gets mailed to you, it's 2 pages, 4 sides. Okay. And on the very first page, the only bit of information you'll find useful is in the upper left-hand corner. And in that upper left-hand corner, I guess technically speaking, your right-hand corner, if you're facing the statement, it lists your benefit at your full retirement age, that primary insurance amount. Once you turn to the inside, the second and third pages, that's really where you see all the good stuff. The very first line on that second page reminds you exactly what it told you on the first page, which is here is what your benefit at full retirement age is. The second line, different than this slide, shows you what your benefit would be worth if you waited till age 70. That's an 8% per year increase. It also shows you what you would receive if you took your benefit early. By early, I mean at age 62. This chart shows you based upon the year you were born, when your full retirement age is. Keep in mind the last update was made back in 1983. You get a reduced payment for taking it early. That actually makes sense because you receive Social Security till when? You're probably thinking until I die. That's exactly right. So doesn't it make sense that if you started collecting at 62, you would receive more payments during your lifetime? And because you're going to receive more payments during your lifetime, they're going to reduce the dollar amount and the percentages are reflected there. Now, keep in mind, for a lot of us, we get to the latter part of our career. Maybe some of us don't feel like we've saved well enough. And we get this great idea. And the idea is, I'm going to turn on Social Security and keep working. And the government allows you to do that. But as you can see on this slide, they don't want you making a whole bunch of money. As a matter of fact, if you're under your full retirement age, they allow you to make $17,640 per year. That number goes up once you hit the year that you will attain your full retirement age in. And then the third bullet point shows you that once you hit your full retirement age, you can make an unlimited amount of income and none of your Social Security benefits would be withheld. Now, this chart is pretty straightforward, but there's one question I get every single time I show it. And here's the question. What if I retire in the middle of the year? Or what if I retire at the end of the year? Said simply, if I made $50,000 from January 1st to June, does that mean that I can't collect starting in July? In the first year you receive Social Security, they only start tracking your income starting with the first day of the month that you collect your first payment in. Let me give you a quick example. Every July, I talk to a whole new wave of retiring teachers. Keep in mind the school year, generally speaking, ends in early June. Many teachers choose that as an opportunity to retire. And from January to June, they made well more than $17,640. And so they want to know when they can turn on Social Security. And my answer is pretty simple. If your last paycheck is going to come in July, and if that last paycheck is going to be a pretty sizable paycheck, let's wait to collect your first benefit till August. But if your last paycheck is going to come in the month of June, go ahead and apply for your Social Security benefits to start paying in July. As long as you are under your full retirement age, it's important to understand that they cap the amount of income you can earn before they start to reduce your benefit. They reduce your benefit payment by $1 for every $2 you go over these thresholds. But I mentioned my dad a few times. He's still working. He's 69 years old. His full retirement age was 66. He started collecting Social Security then. Why? Because for some of you on this call, you may work until you die. For some of you on this call, you might have saved so much money or spend so little or some combination of the two that you're going to be A-okay. What's the point? For some of you, you may want to turn Social Security into an asset. Because keep in mind, when you die, Social Security dies with you. Yes, if survived by a spouse, your benefit may go to him or her. But keep in mind that it eventually goes when you both go. People who won't run out of money before they die could consider turning Social Security into an asset. My dad waited to turn on Social Security until he hit his full retirement age because of the previous slide. Once he hit his full retirement age, though, when the income was no longer capped, he went ahead and turned it on. Now, you get an increase in benefits for delaying past 66, and I caution, be very, very careful about this. 8% growth of your benefit is incredible, especially in the low interest rate environment we've been in for more than a decade. But I would point out, right, that the 8% is not reason alone to delay till 70. The vast majority of articles you read, the vast majority of publications you might come across do suggest that a person wait till 70. We want you to understand that it's based upon an actuarial exercise. This particular slide implies the opposite, that reinforces what I just said, that you should all wait, or we should all wait for as long as possible. Because look at the sheer dollar amount difference of taking it at 62 versus 70 judged by monthly benefit. That 8% growth rate compares very favorably to a whole lot of metrics that we track every day. But this slide starts to bring it together. This is a simple break-even analysis. What you'll notice here, that if you plan on dying before 78, you should take Social Security at 62. Don't overthink what I just said. That's exactly what this chart says. And if you plan on living beyond 82 and a half, waiting may make some sense. And the longer you live past 82 and a half, the more sense having waited will make. But I would just ask you, are you going to be more active at the beginning of retirement or the second half of retirement? I believe I'll be more active at the beginning of retirement, and therefore I'll be spending more money at the beginning of retirement. To close out this slide, if you plan on dying, like most people, right around life expectancy, it really didn't matter the age you were when you turned on Social Security. You're going to collect roughly the same amount. So as we finish today's presentation with a few real-life examples, here are a few other factors that are important to consider. Number one is health. If you are a less healthy person, generally speaking, you're going to live less long than a healthy person. If you are a single person, your benefit dies with you. Whereas if you're a married person, your benefit gets passed on. Think about the break-even chart we just showed. Most of the men in my family don't live very long. I can sometimes be pretty pessimistic about my own health. But it's not just about me. My wife had a great-grandmother who lived to 104 when no one lived to 104. She had a grandfather who was actually in Pearl Harbor. He died at age 89. That's a pretty long life for a World War II vet. I need your help with this one. Her grandmother's not buried by her grandfather in the cemetery. I'm wondering if from afar you know the reason why. In live presentations, it makes for a good punchline, but the reason is my wife's grandmother's not dead. She's 97 years old and shows no signs of slowing down. Keep in mind, something happens to me, my benefit gets passed on to my wife. Your years in the workforce are important, and of course, maybe the most significant variable is other retirement plan assets. And other retirement plan assets certainly give you the opportunity to have more flexibility when it comes to deciding when and how to take Social Security benefits. I'm now going to switch over to one of our software tools, a tool that we'd like to demo because as a thank you for joining us on today's webinar, if you want to make this a little bit more personalized, if you really want to cater or customize the Social Security strategy to your plan, this is really one of the best ways to do it. So I'm going to take a moment, run a few examples just to get all of our minds thinking, to really show you how this works. And I'm going to start with a married couple. I'm going to have both people born prior to 1953. So as I mentioned, this is the software tool itself. We're going to run a few scenarios for you. The first one, we're going to run a husband and wife. In this case, we're going to have both people born prior to 1953 for a very specific reason. Their full retirement ages are 66. And for anyone on this call born prior to 1953 and not yet collecting, you would want to know that you have the opportunity to do something called a restricted application, which most people do not have the opportunity to do. And as I plug in this data, I'm going to show you the results. So what we did here is we took individuals' estimated full retirement age benefits. We took their year of birth. That's all we need in terms of information for you. And then we plugged it into the software. We assumed life expectancy of 85 and 87. and the software immediately does the break-even analysis for you. Because these two individuals were born prior to 1953, it's important to understand that that restricted application allows one to draw spousal benefits off of the other without negatively affecting or causing their own benefits growth to stop. I mentioned spousal benefits because for individuals, spousal benefits themselves work this way. My wife is entitled for either the larger of my own or the larger of her own or up to half of mine. Let's use some real numbers, real examples. My benefit's worth $2,000. Her personal benefit's worth $750. She's going to receive the spousal benefit. She receives that spousal benefit while I am alive, right? Because when I die, as we touched on before, she will take over the survivorship payment, which was my full payment, okay? Another example, I'm going to rerun a single individual because at the end of the day, as mentioned, the benefit dies when you die. And we wanted to show you how a break-even analysis might look for that person. Now, keep in mind, when we use life expectancy, if I had this person dying before age 78, it would say that they should take Social Security at 62. But in this particular case, I wanted to show you the dollar amount of difference between taking it at 62 versus that individual waiting till age 70. That's a $165,000 difference. Collecting at full retirement age splits the difference. But what this allows us to do is to show an individual who might say, well, I'm not sure I'll be retired at 62, but I know I'm going to be retired before 65. So would you mind running it at 64? And what you can see is that delta becomes tighter and tighter or smaller and smaller. Social Security benefits accrue on a monthly basis. And because they accrue on a monthly basis, there is no significance to waiting till the end of the year or your next birthday before collecting. Keep in mind, you're going to receive 1/12 of that 8% growth rate for every month you delay. We have the ability to run a scenario for a widowed individual. Some of my least favorite conversations pertinent to Social Security, but it's important to understand that widow benefits do exist and there's some strategy at play. So we already have the survivor benefit plugged in at $2,500. We're going to make the individual benefit, the survivor's benefit, worth $1,700. And what it allows us to do is to see how to prioritize or how to, in essence, stack. Do we collect the individual, the survivor's benefit first, and then take the survivorship benefit? Or do we shift the order? And then lastly, we have the ability to run the scenario of a divorced individual or a divorced couple. Here's the way that Social Security works for divorced individuals. My mom and dad got divorced after 19 years of marriage. They've now been divorced 30. My mom is not married to another person. And because my mom did not marry another individual, or I should say isn't currently married to another individual, and because her marriage to my father lasted more than 10 years, she can receive the spousal benefit based upon his work history. Keep in mind, she's entitled to receive up to half of his benefit while he's alive. But even though my parents have been divorced for 30 years, should something happen to my dad, should he die, my mom would take over his full payment. To complicate this example even more, my dad went and got married for the second time 10 years ago. And so here at play, we have spousal benefits applying to a current spouse, an ex-spouse, and of course, survivorship benefits for both. In case you're curious what that is, my dad's current wife can receive spousal benefits now that he's filed. For married individuals, the spouse who's collecting the spousal benefit has to wait for that other individual to file. In the case of divorce, my dad simply needed to be eligible for my mom, his ex, to go ahead and file for spousal benefit rights. We went through a lot of information through the slideshow, and at this moment in time, we're going to switch over to the Q&A portion of the presentation.
If you have any questions for our speaker, we are monitoring the Q&A section at the bottom of your screen. I believe there have been some submitted questions so far. One of the questions is, do we, the attendees, have access to today's Social Security analysis tool?
Thank you for the question, whoever asked it. The answer is yes. And you would go about getting access to the tool, or more specifically, a customized report ran for you, by reaching out to both Kyle and Jonas. What they will need from you is your estimated benefit at your full retirement age. Again, if you weren't able to jot it down and don't have a recent estimate, you would want to go visit ssa.gov, the Social Security website, and make sure you receive an updated estimate. Once you have that, the only other thing we need is the year of birth and any pertinent information related to spouses, ex-spouses, or deceased spouses. And we're happy to run that for you.
I have a question. Can you run a single woman born in 1966 using the Social Security calculator?
Yes, we can run a single person born in 1966. And outside of the same information that we had made mention of, right? Full retirement age estimate and birth year. If there's any specific bit of information that that individual might want to share, whether it be health related, or maybe said better, if they had any specific life expectancy assumptions that they wanted to see, we have the ability to change those life expectancy assumptions as well.
Ryan, I have another question. What benefits does a wife who hasn't worked outside the home entitled to?
It's a very good question. And that comes back to spousal benefits. And the question is so good, it gives us the opportunity to review it one more time. Spousal benefits apply for all of us. But the way that spousal benefits work is the Social Security Administration allows you to receive the higher of your own benefit. That would be the benefit that you have achieved due to your own work history, or half of your spouse's. Now, for a married couple, the important rule is the individual who has the higher benefit, the one who in this question worked outside the home, they have to have filed for their benefit. Once that individual files, the spouse who worked inside the home is able to make that spousal benefit claim. If we were talking about the case of divorce, the only difference is once the person who worked outside the home is eligible to receive, the person who worked inside the home would be able to start collecting.
Ryan, a participant is wondering if there's a cap for a worker and their spouse that can be paid in a month.
I think what that person is referring to is on each one of our statements, you will notice something called a family maximum benefit. And I appreciate the question because it can be somewhat misleading. On that individual statement, it might say that the family maximum benefit for their household is $4,000. And yet they might be looking at their individual reports saying, wait a minute, mine's $2,500, his or hers is $2,500, that's a total of $5,000. Said simply, family maximum benefits only apply when there are dependent children and there has been a death of one of the individual workers while those dependent children are still in the household. The short answer to your question, Jonas, or the question posed through you, is that no, there is no maximum amount and a household could collect, except for having two people who both receive the highest possible Social Security benefit, which in 2019 is just short of $2,900 a month. But no, in theory, there is no maximum benefit that people are capped at or to.
I have another participant who's wondering if you can go back to slide 29 and review it one more time.
Up and just to be able to get through a few of the other questions, just so everyone on the call knows, that's the break-even chart, and it's referenced on. If I'm taking the person's question right, it's the break-even chart. You might read in the rest of the question, Jonas.
No, that's it. Just wanted you
Oh.
to review this slide one more time.
To review the slide. Well, if I'm on the same page and reading it right, it's the break-even chart. And that break-even chart, the way that I set it up was there are 3 lines at the bottom. They represent the 3 primary Social Security ages of 62, 66, and age 70. And there are then lines to show you vertically at which ages you would ultimately break even or cross over into the next age band, if you will. And the easiest way to read this slide is if you plan, and I say this tongue in cheek, but being deceased before age 78, the chart clearly shows you should take Social Security as soon as possible. For anyone who's delaying, right, or who plans on living forever, this chart implies that they should wait as long as possible to collect Social Security. And I love the opportunity to review the chart, even if I wasn't able to pull it up in the essence of time, because it's really important to understand that even for the individuals who believe that waiting is the right path for them, that's great. But keep in mind that doesn't mean you have to wait to age 70 no matter what. Said simply, if you are in a position, a financial position, to be lucky enough or fortunate enough to be able to delay taking your Social Security benefits, let's delay, right? And then let's revisit that question as more information comes in. One of the variables we didn't get a chance to talk about is, of course, market and where we're at in the economic cycle. We're far into this cycle, right? At some point, we'll see less positive data, and maybe that's what allows an individual to turn on benefits. You might get a health scare in the next year. That would certainly change anyone's perspective of their own life expectancy. I apologize for not being able to get the slide pulled back up quick enough, but hopefully that serves as good review.
Ryan, I have another question. My wife is older than me and her benefit will be small. Will she get half of mine when I file a few years later, or should she wait?
So it's a great question. Keep in mind the way that she's not in the question, in the example, she's not receiving spousal benefits today because she's not eligible until her spouse, in this case, younger spouse, turns on his or hers. The short answer is yes, she will switch from her own small payment to a payment that's close to or is half of his. Spousal benefits, just like individual benefits, the earlier or younger you are when you apply for it, the smaller spousal benefit amount would be. But because the way the question's asked with this individual being older, I would generically say yes, they'll switch from their own smaller benefit to the 50% spousal benefit once their spouse turns on their Social Security.
Ryan, another question from a participant here. For someone below the full retirement age, what income is used to determine a reduction of benefits?
The income is simply wages, tips, and earnings, right? That is it. If it is $1 of income that you pay the FICA tax or payroll tax on, it counts. I'll give you a few examples, Jonas. My mother receives a pension plan from the state. Pension proceeds, pension income is taxable. And yet you don't pay FICA taxes on pension income, and therefore her pension income does not count against the income threshold. You may receive interest or dividends or have capital gains you receive. All of those would be reflected on your tax bill to the government, but none of those things cause you to pay a FICA tax. The short answer is any wages, tips, and earnings. One last point, it's the wages, tips, and earnings of the individuals receiving the Social Security benefit. If my wife is collecting Social Security, my income, my wages, tips, and earnings has no negative impact on her benefit amount. It changes the structure of her taxation of her benefit, but per the question, it doesn't change the amount that she receives.
Here's another question, Ryan. When Social Security asked me what income was what my income was last year, is that gross earnings or adjusted gross earnings?
So Each government program uses some version of modified adjusted gross earnings. Each definition of that, depending upon the benefit program, is slightly different, but largely the same. So the answer is they're looking at your modified adjusted gross earnings. That's the number that they're using in that calculation.
Another question, can I collect PERA and Social Security?
Unfortunately, Kyle, I'm not sure what the individual is referring to when it comes to PERA. My only assumption is it might be a pension benefit of some kind. I guess there are a few pension benefits that allow an individual or don't allow an individual to collect Social Security, and I'll just give you a few examples. I'm in the state of Wisconsin at this moment in time. The only people in the state of Wisconsin who really didn't contribute into the Social Security program through their income or pay that they received were railroad employees and postal workers. Most postal workers in Wisconsin have long since started contributing to the Social Security program. But because they receive federal pensions and they didn't contribute to Social Security, they would have or be subject to the government pension offset provision. I don't want to spend too much time on it because it's such a small number of people in terms of percentages, but guessing that might be what that individual is referring to. If I'm totally off base on that, I apologize.
Ryan, how do I investigate if 1 year my earnings says I earned 0 and I did file taxes for that year?
Yeah, it's going to be a long process and unfortunately probably not a very fun one, but I would certainly encourage you to contact the Social Security Administration. I would do that over the telephone, and I would have them send you the needed paperwork to get that program changed. I'm hoping you have your tax returns from that said year, because that's of course the easiest way to prove. But I would also wonder aloud, was that the year that this individual might have been married? And quite often, if there's a legal name change, marriage being one example of how that might happen, quite often that's where the Social Security Administration would have missed out on a potential year of earnings.
Here's another question. Ryan, do you pay taxes on Social Security benefits?
Yes, you will pay tax. Well, I was quick to say yes. So, Jonas, the answer to your question is it depends. If you have modest modified adjusted gross income in your household for a joint couple, that would be under $32,000. You don't pay taxes on Social Security benefits. Between $32,000 of modified adjusted gross income and $44,000 of modified adjusted gross income, you would pay taxes. That is your rate. Let's say the individual's in the 20% federal rate, you would pay 20% taxes on half of your Social Security benefit. Finally, for anyone on the webinar who believes that their modified adjusted gross income on a household of 2 level would exceed $44,000, keep in mind they're taking into consideration the dollar amount of your Social Security benefit as well in that calculation. You're going to pay taxes, again, your ordinary rate on 85% of your benefit. One last example. You have a $1,000 a month benefit, your income's over $44K, again, modified adjusted gross. You will pay your effective rate on $850 of the $1,000 benefit.
Ryan, another question. If one spouse is a high income earner and the other is a lower income earner, does it make sense for one of them to apply earlier than age 70?
I love the question. The short answer is probably. Keep in mind, when death comes to one of the two, the smaller of the two payments goes away. So if we're ever going to defer one of the Social Security payments, we want to defer the bigger one. The reason is that's the one that gets paid to the household the longest. So going back to the example, if the person with the smaller benefit wants to go ahead and file, it serves as a nice reduction on having to take money from other saving sources. And of course, once or should something happen to either person, it's a little bit of way of playing defense to make sure that the couple feels they're getting out of the Social Security program, what they contributed to it? I like that question.
Ryan, when does the Social Security office send out a summary of the money I have contributed to Social Security?
So page 3 of your Social Security statement shows you a summary of what you've contributed to the program itself. On that page, there are 3 columns of numbers. The first is the year. They break it out by decade. The second is the amount of income they reflect you paid Social Security tax on in that said year. And the third column shows you the amount of income you paid Medicare taxes on during that year. The easiest way to read your statement or to figure out how many years did you max out your obligation, if column 3, the Medicare column, has a higher number than column 2, you maxed out your payroll tax obligation for that year. Remember, in 2019, you stopped paying payroll taxes just short of $128,000. You will pay Medicare taxes on every single dollar of income you have.
We have time for one more question.
Brian, I'm a consultant and my LLC receives income. How am I contributing to Social Security?
So, depending upon how the income is being passed to you in terms of, without being a tax specialist, if you're paying yourself as an employee out of the LLC, then technically speaking, you're paying payroll taxes on the employee wages. That's the short answer. What I would particularly pay attention to is who else is receiving income, Social Security taxable income from the LLC. I'm openly wondering aloud about a spouse. And where I'm going with it is this, is that the program has its rules in terms of when an individual can start, how the benefit amounts are collected, calculated, estimated, etc. Well, my wife has an aunt and uncle who own an excavating company. The uncle does most of the excavating, and therefore, for most of the time, he's been the highest paid employee. Well, he turned 62, and he's one of these bird in hand types of people. Sure, some of you on the call are like that as well. And he wanted to turn on Social Security, no ifs, ands, or buts. So I showed him that income chart and said, listen, Uncle Bill, you make a lot more money than $17,640. Turning it on is not going to make sense. Well, he did something pretty simplistic. He gave himself a drastic pay cut. And just so happened that he gave his wife a tremendous pay increase. Keep in mind, she was a few years younger. She wasn't able to collect Social Security benefits in the first place. And that allowed the household to keep acquiring or increasing Social Security benefits, but it also allowed the uncle to take benefits without having income withheld due to exceeding the income limit.
Great. Well, that's all we have time for today. Brian, thank you so much for joining us, and thank you to our sponsors, Kyle and Jonas from RBC Wealth Management. A few quick reminders. There's a Patina Nation 401k plan that you can learn more about on patinanation.com, a group medical plan, and many other benefits of being a member of Patina Nation. All of that can be found on patinanation.com. And if you would like to receive a copy of your Social Security maximization report, feel free to reach out to our 401k advisors, Kyle and Jonas. Their email is up on the screen right now. Or if you have any feedback or unanswered questions for our presenter today, feel free to reach out to Kyle and Jonas for that as well. So thank you to all of our Patina Nation members who were able to join us today. We appreciate you joining us for the hour.
This has been a presentation of the Patina Nation. To watch more content like this or for more information, please visit us online at www.patinanation.com.